3. Volatility could be the new norm. If portfolios continue moving toward of the moment, social media influenced investment decisions, and if shorter time horizons become the norm, volatility could rise across the board. Already, we've had glimpses, the seemingly endless GameStop saga, the flash in the pan NFT boom, and any number of viral crypto rallies. Now, as wealth flows into portfolios driven by cultural narratives, mission alignment, or influencer sentiment, the markets could see faster boom and bust cycles across things like AI, crypto, or biotech. Bigger inflows and outflows based on headlines or hype, not fundamentals. Traditional valuation models under strain as pricing detaches from earnings and latches onto story or social engagement. Fintech, creator platforms, Web3, and real estate tech may thrive if they continue to capture the imagination of Gen X, Millennial, and Gen Z investors. Meanwhile, traditional players, bond-heavy funds, legacy wealth advisors, phone-based platforms may face declining inflows unless they adapt to this faster, more personalized investment culture. None of this is set in stone, mind you. But if these trends gather steam, the implications will be huge. Long-term investors may need to navigate noisier, more reactive markets. Active traders could find more short-term opportunities, but also more traps. And platforms and policymakers may be forced to adapt to a landscape where speed, mood, and digital community matter more than steady compounding or price-to-earnings P/E ratios. The old signals we used to rely on might not work as well anymore, so we'll need new ways to figure out what's really going on. Part 3. How to invest. You can position yourself for the great wealth transfer by targeting industries like fintech, crypto tech, real estate tech, private equity, and death care. A mix of ETFs and individual standout stocks, including some of the ones I'll list here, could help you capitalize on the big trends and back clear long-term winners. I've structured this investment mix around how entire industries are likely to be impacted by generational change. Within that framework, I also diversified across behavior types. Some investments appeal to DIY retail traders, others to passive institutional investors, and some ride the influence of social media-driven ideas. The approach blends ETFs and single stocks. ETFs will give you broad exposure to a slow-moving theme without betting it all on one horse. Individual stocks, meanwhile, will allow you to place a bigger stake on standout companies. That balance can keep you exposed to overall growth themes while managing your risk. Just a quick note, you don't need to buy or short everything listed here. Instead, pick the assets where you have the highest conviction, the ones that resonate most with your outlook and risk appetite. Companies like Robinhood and Safi have built entire models around mobile-first, user-friendly trading experiences that fit with their digital sensibilities. And then there's Coinbase, which has positioned itself as the gateway into the crypto economy with trusted custody and trading services for retail and institutional players. A few legacy finance firms like Charles Schwab also look well positioned here. Studies suggest that around 86% of heirs fire their parents' financial advisors, so companies that actually empower self-directed investing could be major winners. Schwab does this well with low costs, strong digital tools, and a trusted brand. In this space, I lean toward picking individual stocks, mostly because some clear leaders have already emerged and are likely to dominate. Crypto infrastructure is another massive opportunity that comes alongside this trend. As Bitcoin, Ethereum, and decentralized finance DeFi become part of the mainstream conversation, businesses providing the infrastructure, think exchanges, custodians, and corporate treasuries, could see serious growth. Coinbase again will be critical here, acting as both a retail and institutional investing on-ramp. Galaxy Digital could also thrive. It offers exposure to crypto trading, asset management, and venture capital for a broad sweep across the ecosystem. There are also ETFs that invest across the whole crypto infrastructure value chain. Funds like Amplify Transformational Data Sharing ETF ticker BLOCK. Expense ratio 0.76%, VONEC Digital Transformation ETF DAP 0.51%, and Fidelity Crypto Industry and Digital Payments ETF FDIG 0.4%. Create a diversified exposure to the broader infrastructure network, including exchanges, miners, and blockchain technology firms. These ETFs can be a good alternative if you want to capture the fundamental growth of the industry while smoothing out some of the single stock volatility. Real estate-linked stocks could also be coming into their own, with billions of dollars in property being transferred from one generation to the next. Platforms that streamline home buying, home selling, and real estate management are going to have brand new curb appeal. Zillow is already the king of online home browsing, having ripped up the old-school listing model with faster, cheaper, simpler sales. But don't stop at the market's tech offerings. The quiet giant here is high-end real estate investment trusts REITs. Heirs won't just get cash, after all. They'll be taking possession of luxury. That means serious value will be tied up at the top end of the market. And REITs like Equity Residential, with its grip on high-end urban apartments, and Avalon Bay Communities, with its focus on affluent metro corridors, are perfectly positioned to soak up this wave. If you're looking to grab the upside of the real estate reshuffle, you'll want a smart mix: direct stock picks for growth, diversified premium REITs for durability.